So the next risk category we're going to talk about is H1, which is asset risk for non-affiliated entities. The risk here is more of a risk of asset default or fluctuation in fair value. Think of things like investments, receivables. So we're going to dive in to a little more detail on what the associated charges are for those. So starting with bonds. So for health carriers, this represents about 39% of the industry's total invested assets. And the RBC charge utilizes the NAIC rankings. So NAIC 1, as a reminder, highest quality to NAIC 6 is the lowest quality. You can see here where the S&P ratings generally fall for those categories. For the purposes of our discussion today, remind you that NAIC 1 or 2 rated bonds are considered investment grade. Here is a listing of the RBC factors for bonds. You can see it falls just directly in line with those NAIC ratings. So the US government is assumed to be pretty low risk, obviously, as a 0% factors applied to direct and guaranteed US government. And then NAIC 1 is 0.003, and then it increases to ultimately, if you have an NAIC 6 bond, it has a 30% charge. Note that when you're applying these, the factors are applied to the book adjusted carrying value is the number you're going to apply these to. Equity assets. So here we'll talk about both preferred stock and common stock. Preferred stock behaves very similarly to bonds. They usually should have an NAIC rating, and it would fall into the same factor categorization that we just talked about. For common stocks, they don't have an NAIC designation. So if it's a non-government money market that has a 0% charge, then all other common stock is lumped into a 15% charge. So that's a little bit of an easier breakout.